everybody! It's Friday, May 15th. How y'all doing? I hope everybody's safe. I hope everybody is well. Now, let me tell you, I'm not happy with what I'm seeing right now. There are, I check these things every single day. I'm looking for any sign, any little glimpse, any green shoots of a resumption in economic activity. We know, and I've been telling you, that an unprecedented amount of fiscal support has been injected into the economy. All right, we're up almost 800. Well, we were up over 800 billion. We're about 780 billion over same time last year. The deficit now is 1.66 trillion. That is the largest nominal deficit in the history of the U.S. And it's about 10.5% of GDP if we use forecasted GDP. If we use like current GDP, it's about 7.6% of GDP. So we know that there has been an unprecedented amount of fiscal support, and that's great. And we see that piling up in bank deposits. Bank deposits, I mean, if you look at what has happened with bank deposits, exploded like unbelievably to an all-time record high over 15, now at 15.2 trillion, and 2 trillion of that came very recently in the last couple of months. So the money's sitting there, and yes, I don't want to get into that whole discussion of it hasn't been distributed equally, and I'm all into that. I'm all over that, believe me. I'm just talking about from an investing market perspective right now. So the fiscal support has been unprecedented. But now, what I've been trying to figure out or try to find out is, are we starting to see some rebound, even the slightest little hint of a rebound in the economy? Now, how would you do that? I'm looking at tax deposits, because as the economy grows or contracts, we have also an increase or a decrease in tax deposits. So things are starting to open up. Remember, I've been talking about that, and it's one of the positives that I have been highlighting is the fact that we're starting to see lockdowns end. Even here in New York State, not New York City, but New York State, 5 of the 10 regions of New York State are open as of today, actually. Still have 5 more to go, and New York City's not open, and actually the governor pushed it back now till June 13th. But things are starting to open up. But here's the thing, where I've been watching these tax deposits, and we had that big collapse, which was understandable because, first of all, tax filings got pushed back till July, maybe even September, but also, of course, the economy was shut down. So there wasn't any real economic activity or just very little compared to normal activity. So we had that collapse in tax deposits, but then it bottomed out. That was a good sign. We saw some stability, and as a matter of fact, you heard me talking about this recently. I've been doing almost all of my videos have focused at least partially on this subject. We saw that bottom out, and I said that's a good sign. At least it's not getting worse, okay? We stabilized. And now they're opening up the economy. States are opening up. We should start to see that move back up even a little bit. That's all I'm looking for, is a little bit of a lot of this business. When you talk about being an investor, it's like you got to be a detective. You got to look for evidence all the time. Like everybody's going to be looking in a certain direction. Remember, I talk about the headline traders. They see something, so the sheep, they all go one way. But you got to be there behind the scenes like a detective, looking for clues that the crowd is overlooking, that they're not paying attention to. If you could do that, and that's really your work. What is your job? That is your job as an investor. Of course, I provide this to my subscribers. But anyway, What has happened now is that stability in tax deposits that I was talking about, it just took a new dive down. A new dive down. Very disappointing, because this has happened even though we've seen already some states start to open up. Not just today, but a week ago. So I was hoping to see some green shoots, some little sign of a rebound. Anything. A tiny nudge up. Just a shift in the trend. It didn't have to be anything big. I'm not expecting, as a matter of fact, anything that would just denote a shift in the, but no. New low. So that's a disappointment. Now, I'm just going to say, got to give it a little bit more time. There was another thing that I want to mention, which is something I follow, which is consumer credit. You're talking about consumer loans, credit card, and revolving credit. Now, I've been saying, and the data has and anecdotal evidence, and the data has been showing that households have been paying down their credit balances with the money that the government is sending out. There has been a contraction in the amount of consumer loans outstanding. That means things like credit cards and revolving credit, automobile loans. There has been a contraction. The only way you see a contraction in the nominal amount outstanding is if that debt is retired, if it's paid down. That continues. Now, when people think about it, when people are paying down debt, they're not consuming, all right? It's not going into the economy. That is a leakage. We call it, in economics, we call that a leakage to demand. That's still going on. And as a matter of fact, in the most recent data, it has worsened once again. So, disappointing. We still have sentiment which suggests a higher market, but I don't know. We got to see the data improve. We have to see the data improve. I'm still optimistic because I think things are starting to open up, but they may not be opening up fast enough. That is the problem. They may not be opening up fast enough. I mean, New York here, Cuomo pushed it back to June 13th. We just got the word today. We thought we were just on the verge of seeing the city here, New York City, open up. No. Another month. California, through the end of July. Not good, man. Not good. It's got to open up. All that fiscal support is fantastic. And I'm, by the way, on a separate note, all right, the loans that the Fed, remember they gave, and I did a whole video about this, of how Treasury gave $450 billion of the $2 trillion initial stimulus to the Fed, which was ridiculous and unnecessary and useless to leverage up. I mean, the Fed doesn't need that. They were supposed to leverage that up to $4 trillion in loans. Only $114 billion has been lent out. So it says to me that companies are not going for these loans. And the fiscal support, I would say, is helping households more right now. Anyway, that's it. Have a great weekend. I'm coming out with the new issue. We'll be out on Monday. As always, go to my website. If you want to read the back issues, you have the whole weekend to catch up. pitbulleconomics.com. Get the link in the description right here below. Have a nice weekend. Bye-bye.